Good afternoon and welcome to today's Facebook Live. I'm Tina Powell and here with Mark Germain, the CEO of Beacon Wealth Management. And today we are going to be talking about inflation and inflation risk. The date is July 25th, 2018. This recording is at 3 p.m. Eastern Standard Time. And a quick note to our listening audience that please, this is only general information and meant to be educational in nature. So if you have specific questions regarding your own investment account, please do so and meet with a qualified financial professional or CFP to answer those questions. So today, Mark, we're going to be talking about inflation and specifically inflation risk. I know that it's been a topic that is now recently in the headlines, and part of that is because of the Fed, and then also too we had the news out of Venezuela this week, some really devastating conditions that their economy is going through right now. And I know that it's been a question this week as well as other weeks on the mind of a lot of your clients, correct?
Inflation is really coming into its own as a question. One, because of interest rates, which we'll talk a little bit about. But inflation is one of the things that people say, well, if inflation comes, then immediately is a recession. They don't go hand in hand. Inflation is not necessarily bad. So we're going to talk about inflation and inflation risk, what it really is. And inflation risk is really the reaction of investments to rising prices. Inflation is nothing more than that. It's really prices going up on the goods and services and what you pay for each and every day. And we all experience inflation of one level or another. So what do they use as a gauge is always the question. How do I understand what inflation is? And it's generally increase in the prices of goods and services. How do they create an index? In other words, in the investment world today, we always talk about an index. What can I compare to? How do I know what to compare to? Consumer Price Index, CPI, is a measure of the average change over time. So from one period to the next period, how much does it go up? And the price is paid by urban consumers for a market basket of consumer goods and services.
And so I know that you have a graph here from, and this is out of the U.S. Bureau of Labor Statistics, that publishes the CPI or the Consumer Price Index. And what I'm automatically seeing here is there's food over here, there's energy all over here, there's all items, and then all items minus food and energy. You want to talk a little bit about this spike over here while this line is so high compared to the others?
I think it's important to recognize that yes, energy has gone up in price, but if we look at this a few years ago, it was down here. It had gone down so much. Remember gas well below $3 a gallon?
I remember it below $3 a gallon and over $5 a gallon.
So we're not even close to the number when Hurricane Sandy hit of what we were paying for gas and for energy in general. So energy has gone up, and that's what's interesting is if energy is the biggest component of inflation, how much inflation is there really because energy had gone down so far? So basically it's just getting back to where it was.
And I know that there are many factors that go within that CPI index. And so here we see that here's a percentage change over a yearly period for all of the different types of items, right? There are many. And as you were just talking about the energy, that is definitely the highest. Fuel, oil, and gasoline for sure. And as I'm looking, the food, which is what we normally think about, right? It's inflation always goes back to the how much do you pay for the gallon of milk, or how much do you pay for?
Here's a change, 0.4%.
Right.
So food has changed, what you use at home. We're not talking about dining out. We're not talking about alcohol and other things that you may have. But food is really only going up 0.4%.
Right.
So one of the things that you need to do when you think about inflation is how much is your budget changing period to period.
And I know that this is a statistic that comes out every month, and the next release date is August 10th, and then the June was just a slight increase.
So inflation, be very careful that you don't think that inflation is bad. You need a natural increase in inflation if you expect your wages to go up as well.
Can you talk a little bit too about other indices that I know that this is another case in point? So economists are not only looking at CPI when they talk about inflation, and the Fed for that matter. Can you talk a little bit about what we're looking at right now?
Sure. So what this is doing is analyzing personal consumption expenditures, which is saying people are spending more. In other words, I don't want to get into intimate detail on what that makes up, but if you think about it, it's saying people are spending more on their personal consumption. Why? They're getting a pay raise, they got a job, unemployment is an all-time low. Right? So we had someone in the office just get a home offer accepted. They're going to pay more in interest than I paid a few years ago when they got a home. So those are the things that are part of everyone's budget, and they need to be thinking about it. So this is saying we are spending more on personal consumption. Again, go back to your basic economics class, supply, demand. If there's more demand, it's going to cost a little bit more to get that supply in line. And of course, if you're in Venezuela, you're now paying $60,000 times what you paid for a cup of coffee last year. So last year you may have been paying a penny, and now you're paying $6 a cup. So Venezuela, if you really want to have a shock to your system, go back to Venezuela. And there's been many, many periods in time. And those of you who are history buffs know that Germany, Venezuela, the United States had its own set of inflationary problems. Take a look at when we were back in the 70s and the 80s, and we had different periods of kind of hyperinflation. I think of 81, and interest rates were 18%. Inflation.
Well, I remember that time too, and I remember too Zimbabwe also too. Didn't they print so much money that they literally ran out of the paper?
Right.
So then, as we're talking about inflation as it relates to investing, which is a core fundamental question, how do you protect an investor or the American taxpayer? How do you protect me against inflation? Is it so much of a risk that my portfolio needs to have some sort of an inflation hedge?
Okay. So be careful about taking a tactic. So we all talk to people about being very strategic in how they invest. And strategic investing is saying, I'm looking at what my objective is, and my objective is to have money out here. Well, if there's a short-term thing going on down here, why do I want to change my investment strategy back here for something that I expect to be in place out here? So always think about what your objective is. So there are strategic decisions that you make, and there are tactical decisions that some people make that we caution people about trying to be too tactical. Proper diversification. The number one thing to help defer the effect of inflation is to properly diversify. That means you may change where you're diversified as part of your strategy. So instead of having long bond positions, you may now have short-term bond positions, and maybe part of your regular portfolio is Treasury inflation protected securities, TIPS. And those securities will go up in value if inflation continues to increase. Hence, it can become part of the strategy. You're not going to buy it for 6 months and it's going to make you a fortune. But what it's going to do is grow in value over time. Here's our objective out here, and it can become part of the strategy. I don't know if that's making sense now.
So if I'm hearing you correctly, then the diversification strategy that you use relates to a client's goals, and the tactics that you use to reach those objectives different. So inflation may or may not come into play for certain clients based on a long-term or a short-term time horizon. In
Correct.
other words, they may or may not need to solve for that. Depends on their goals.
100%. And I think another question, and we haven't talked too much about it, and it's perfect time to talk about it, is interest rates. And it was really interesting. We had a team meeting, and one of the first questions of one of the people at the firm that deals with the investment strategy is a bond strategist, and they said, when does the yield curve totally invert and we go into recession? And he says, what makes you think it's going to invert? But the point is, interest rates are increasing. Interest rates and inflation are tied together. So Powell talked about it. The Fed Reserve Chairman, Jerome, is he related to
I was about to say, no relation.
No relation to Tina Powell, and neither is Colin Powell.
I wish that I could actually have them both as relatives.
Yeah. So, great businessman, really understands not only the economics component, but he understands business, and basically is saying with unemployment reaching a level and the outlook is, kind of balanced right now, the case for continued gradual, keyword, gradual increases in the interest rate, that is our philosophy as well. And we've always told clients, don't be worried about increase in the interest rates. Why? Interest rates, did you do a slide on that?
So no, we didn't,
okay.
But here's the little graph over here.
So what we think about is interest rates go up. That means the cost of borrowing goes up, which means banks do well. Okay? 2, interest rates go up. The cost for the companies that make and produce the goods and services that you provide, it becomes more expensive in order to do production, because they always have to borrow money on a short-term basis. Interest rates go up, the cost of production goes up, the cost of the goods and service goes up. Wait a minute, that's inflation. So interest rates have a direct impact on inflation, both properly managed, which
that was in the earlier
right,
part. We
but
cut
properly
that off, right?
managed. Interest rates can increase gradually, inflation will increase gradually. We're only at 2.5% inflation. And we kind of look at these two different scenarios. Here is original investment, $1 million. Inflation is 2.5%. This is what happens with inflation, is your purchasing power changes. So what you could rate today, spend $1 million on, you're only going to be able to spend $539,000 effectively 25 years from today.
So 25 years today, this assumes that there's no investments at all, is that the money is just, it stays the way that the money is invested in.
The non-investment people
right,
put
cash.
it in their mattress.
Exactly. This is the money that's underneath the mattress. And if I'm looking at the slide, the difference between a 2.5% inflation rate versus a 3% is a significant difference.
Yeah, 0.5% is $62,000 differential for every 0.5%. So if inflation goes to 5, we're going to have 2.5 times that number.
So as in the idea behind a portfolio and investing is obviously to outpace inflation.
Good. That's great lead in that we always tell clients when they say, well, I was thinking of buying this, but I'm gonna put this money aside and I'm gonna buy this next year. How much does that cost? It costs $100. Well, your $100 is only gonna be worth $97.50, so you're gonna have to put more money in next year to buy what you could buy for $100 today. So if you're not going to invest the money and you're not gonna get a return equal to or above inflation, you should buy it today. Don't tell your spouse I said that.
Okay, and I know that you wanted to wrap up just talking a little bit about how inflation affects investing overall. And these are the types of discussions that you're having with your clients and with your team members, the one that just bought the house.
Right. So liquid assets are the most vulnerable to the negative effects of inflation. We just did the $100 example. $100 example is only worth $97.50. Now, that's cash. If it was invested making 2.5%, which you can now get in short-term bond funds, it's still worth $100 at the end of the year. And if you still want to make that purchase, you can make it because you're going to have $102.50 less tax. Reduction in the purchasing power of every dollar over time. There aren't some dollars you can put aside and have them be worth the dollar value. They're going to be worth less. Portfolio construction should be geared to produce returns to or greater than inflation. And that's the net return, because we haven't talked about taxes, which is another of our favorite topics. Taxes and inflation. So here we are. So portfolio construction maybe, and if you're not careful, inflation is going to erode the value of your investment over time. And we tell everyone that we're talking about for retirement, the greatest financial risk to your retirement goals is inflation. Hence, even at the 2.5% number, we showed you 25 years from now, what you think you're saving is only purchasing half of what it can purchase now. And if inflation goes up, it might only be 40% or 30%. It's going to be less. In combination with understanding interest rates, what happens?
Right.
Inflation, then you can meet whatever the goal is. If it happens to be retirement, we have a lot of people that are focused on retirement.
So if anyone wants to discuss their retirement goals with Beacon Wealth Management, what do you suggest?
Oh, that's a great question, because one of the things we do is we constantly have people saying, I'm thinking about retiring, this is what I'm going, and we say, fine, come in, we will give you complimentary 45 minutes, sit down, say, can you actually retire on what you have? A lot of people wonder, can I retire on what I have? Come in for 45 minutes, no obligation, and we will actually share with them if they can make it or not make it.
Okay, so you heard it here first. Thanks very much for listening on today's Facebook Live about inflation. And if you want Mark and Beacon and the rest of the team to take a look at your retirement goals, then send us a message on Facebook Messenger or get in touch with Reshmi, RESHMEE at BWMLLC.com, and she'll be happy to set up a complimentary 45-minute session. That's nice. Everyone have a great day, and thanks for listening. Our next broadcast is our live webinar on Wednesday, August 1st at 3 p.m. for Q2 2018. Thanks everyone, and have a great day. Bye-bye.